Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
The good news is that we have an environment in which we're not seeing any acceleration in inflation. If you look at the core print, 0.3% in line with expectations, in line with the last few months. Yes, it is a little bit hotter than the Fed would desire, but you're seeing that inflation on a year-over-year basis is still moving closer to the 2% target.
I think food prices have probably seen their lows. Look at what's going on in cocoa, look at what's going on in coffee, look at what's going on in sugar, and now look at what's going on in the grain markets, which have stopped going down, and I think we're going to start to go higher. So I think inflationary pressures from commodities prices will be much stronger. Well, I shouldn't say much stronger. Will be stronger next year than has been anticipated.
I expect there would be a little more leniency towards M&A, but not a dramatic difference. The courts have been pretty supportive of the challenges that Lena Khan and Jonathan Cantor at DOJ have brought in the last 3.5 years, and they are focused on really problematic mergers like Kroger-Albertsons. So while there may be more leniency, I don't expect a dramatic change.
We got 1 hour to go until the market close. So taking a look at the major averages here today, we have a rally, may push the S&P to a new record. We'll see where the Dow ends up. Right now, it's slightly lower by about 20 points or so, but that's not even 1/10%. The S&P 500 up about 0.9%, and the Nasdaq decidedly leading gains today, up 1.8%. Of course, this morning we got CPI data, came in line with estimates, Josh. But what has been remarkable today has been that push upwards in large cap tech.
Yeah, big tech is taking the headlines. I think at least in part, Julie, you can certainly chalk that up to money managers chasing those winners into year end. I mean, a question is, and we have some smart strategists and market pros will ask, if you were a viewer or investor and you're looking at this today, do you want to add to those positions at these levels? Because there are some interesting challenges here. I mean, we can for sure talk about valuation, but you can also throw politics in there, regulation in there.
Yes.
All these moves coming as Trump continues to put together this team. And look who he wants to run the FTC. Look who he wants to run the FCC. I mean, these are guys who are seen as just tough on big tech.
Right. So we'll see if all of these gains are justified. But in the meantime, Tesla at a record today, Alphabet at a record today, Amazon at a record today, Apple at a record today. What am I forgetting?
I think you covered a lot of them.
I know Microsoft and Nvidia are not at records today.
How much of this too, I mean, I mentioned, money managers. I wonder how much too this is just, listen, flows. It's just, is money moving into the market, how much of that wave is just going to find its way into those big passive funds as well?
Right. It's a good question.
All right. We have just the person to ask that question, thankfully. For more on the latest market moves, let's welcome in Michael Kelly, PineBridge Investments Global Head of Multi-Asset. Michael, it is good to see you. Let's start right there. Michael, I'm interested to get your take on these moves we've seen in big tech. What you make of it, Michael? Is this mostly just performance chasing as we round out the year here?
I think there is a little bit of that, Josh, but going back about 2 weeks ago, Jane Fraser of Citicorp, Jamie Dimon, they were together on stage, and people asked them, well, how do your clients, what do your CEOs think of the election? And they said, it's really raised their animal spirits. We saw the Small Business Administration yesterday come out and see those animal spirits popping. Technology heads of chief technology officers are starting to talk about those budgets going up. They've been very flat and repressed. So, I think we're seeing animal spirits in the corporate sector, and people in the stock market are just getting a leg up on that. Global growth gaps are poised to widen. This is the best market kind of on the globe. It has a little bit of a tinge of, the late 90s to it, where rates will bend down a little bit, growth and profitability will bend up a little bit, and people are going into what they think the most exciting part of the market is.
So I guess then the question becomes, are all of these animal spirits going to be backed up and justified with actual stuff, with actual policy, with actual corporate earnings growth, et cetera.
And, we think if you look to the end of next year, yes. Could you have a wobble along the way? Sure. We could always. The market is, very unanimous in their view of things. They love the U.S., they hate Europe. And, when you get that, it doesn't usually mean everybody's way off. They may be way off sides of the near term, but usually they're right over looking out a year or so. So I think that is the right prognosis. I think the U.S. is going to pick up pace, margins are going to pick up pace, and it's going to be a good year for the U.S. stock market in particular.
As Trump moves back into the White House, Michael, what's interesting though, it feels like to me like investors are focused very much on sort of the pro-growth, pro-business side right now. So cut taxes and regulations. There is another side to that coin though. We can talk about terrorists, we can talk about immigration. I mean, are we making a mistake here and only focusing on the potential positives?
Well, maybe we're only capable of focusing on one thing at a time. For the month or two leading up to the election, they were only focused on the negative. So tariffs negative, taxes negative, this negative. Now everything's positive. So, blame it on money managers, I guess. We'll plead guilty. We tend to focus on one thing, then the other. But it is a balanced mixture, right? It was originally painted as just all run hot. And now people are discovering, oh, wait a second, there's some actually very supply-driven, business-friendly initiatives here. Isn't that good? This is reminiscent of the first time he was elected. As you know, that was going to be a disaster, and the market sold off for about 4 hours, and then people said, oh, taxes down, regulation down. What's so bad about that? So to me, we're just going through that all over again.
Do you think there are certain sectors or parts of the market that are going to look better?
Well, I think instead of the one-way street sectors where it's all about big tech, I believe what we'll see is a bit of broadening out. Not by necessarily those big tech stocks underperforming, but just more stocks in general having a reasonable prognosis of a double-digit gain. We happen to like U.S. mid-caps. We also like a lot of these larger technology companies, but mid-caps usually do well in soft landings. They usually do best in soft landings. People don't go all the way down to small caps, that need big interest rate cuts to justify them. But broadening out, we think, there are a lot of good places to be.
You talked, Michael, about interest rate cuts there. Just interested to get your thoughts on the Fed, because we got that CPI print this morning, and it was in line. I think a lot of the commentary and focus quickly shifted to, wait a minute, have we actually kind of stalled out here on our way back to the Fed's target? And you couple that with, as you note, economy's growing, stock market's working. And what do you think you add that up? What do you think it means for the Fed looking ahead?
Well, and on our way from 7% inflation to 3%, we've been zigzagging our way. We've had a lot of these mini cycles where inflation was incredibly good for 3 to 6 months, and then all of a sudden it backed up a little bit. When you look at all the big data on prices, they continue to come down. So we're cycling up a little bit. We're diverting from sort of all what the big data signals are signaling. We actually had a break today in sort of shelter costs, which have been, the big boogaboo. And we do think that, the biggest story is productivity. After a very stagnant decade, is back on its feet. It's rising. We're at the beginning of this huge AI build out. It's the pickaxe and shovel stage. When it gets to the apps, there's a really good prognosis. We could be in a very strong productivity period. That's usually good for growth, it's usually good for margins, it's usually good for disinflation. And so I think people are just, they're looking out and saying, next year, okay, we're starting the year a little bit on the hot side, but we've seen these mini cycles before. We have productivity on its way. You don't find many examples where productivity is already reasonably high and heading higher, where inflation becomes a problem.
Well, we're going to continue this conversation in a few minutes with an economist. But Michael, thank you so much for coming in. Good to see you.
Nice
Appreciate it.
You.
We're just getting started here on Market Domination. Coming up, Broadcom reportedly designing an artificial intelligence server chip for Apple. We'll get you more details on that on the other side. Plus, shares of GE Vernova higher today after raising its multi-year guidance. We're joined by the company's CEO later in the hour to discuss that outlook. Stick around, much more Market Domination still to come.
Yahoo Finance has been releasing its coveted annual Company of the Year award since 2014. We'll reveal a winner in the following categories: Company of the Year, Surprise of the Year, Product of the Year, and Comeback of the Year. Be sure to tune into Yahoo Finance starting December 16th for the big reveal. Trust me, you won't want to miss this stuff.
It looks as if the last of inflation will not go without a fight. CPI came in as expected today, showing inflation remains stubborn in areas like groceries and gasoline, but came down in other areas. Joining us now, Tiffany Wilding, PIMCO Managing Director and economist. So what is your overall read on not just the reading today, but what we've been seeing in terms of this last little persistent bit of inflation that is not decelerating more?
Yeah, well, so I think that the most recent, reacceleration in shorter term momentum inflation measures. So people like to look at 3-month over 3-month annualized. I think a lot of that is the result of, some temporary factors We've seen the pricing pattern around the holidays, shifting around quite a bit post-COVID. You also had hurricanes, which resulted in an increased demand for autos and used cars in particular, because a lot of vehicles were damaged. So I think you see some near-term price acceleration as a result of those trends. But I think when we look at a broader range of data and a broader range of trends within the CPI, what we see is just that labor markets now look more balanced than any time since the pandemic. They're arguably looser than they were in 2019. Some of that has been the result of the immigration flows into the United States we've seen over the last few years. But because labor markets are balanced, that they aren't a source of inflationary pressure. And so as a result of that, you should see inflation gradually moving toward target. In addition to that, we have seen better productivity growth, and productivity should also help to moderate inflationary trends. Now, having said that, though, of course, the speed at which we return to target, I think, is up for debate. The potential implementation of tariffs that's been discussed with the new administration would delay the return to target. Obviously, it would be a tricky environment for the Fed. So I think we have to be cognizant of the risks here. But I think there is good news under the surface, which is that the U.S. economy, is returning to some semblance of normal after a very unique set of shocks that were the pandemic.
So Tiffany, just trying to put a number on it. If we have CPI today and we get PPI tomorrow, we're trying to determine what does core PCE look like, the Fed's preferred inflation gauge. What are you modeling there, Tiffany?
Yeah, well, we think that gauge ends the year. So in December, we think it could end the year running around 3%. So that is not 2-point-something inflation. We've been, very focused on it still continuing to have that quote, two handle. But nevertheless, we think that it will decelerate back down into that 2-point-something range in 2025, even if you have the headwind of tariffs. There's, as I mentioned, I think there's good news in the economy that suggests you do get further gradual improvements. The scale and scope of tariffs will be the risk to that, and it's something the Fed will have to watch.
When you look at the composition of inflation and the different paces that we see here, shelter is now sort of more gradually decelerating. What's interesting is that services ex shelter have inflected a little bit higher here. And I have to wonder about that move and, how much the Fed affects any of this really at these sort of granular levels with some of these products.
Yeah, no, I think that's a great observation. Because I think a lot of this can be idiosyncratic and noisy. And you want to look at, I think, overall trends in inflation, including wage inflation, broader based inflation measures to gauge. Having said that, just look at the shelter components. They have come down. We have seen a moderation in rents and the owner's equivalent rent measure that they use for shelter. That has come down this year. And I think ultimately it's good news. It hasn't moderated as quickly as many people expected, but it is moderating. I think the surge in immigration, especially into some of these large cities like New York City, like LA, that have issues around affordable housing to begin with, has resulted in rental inflationary pressures staying elevated longer there than many people expected. But as these immigration flows have already slowed down with the Biden administration policies, we expect immigration to slow down even more when Trump, takes office. So that will, I think, on the margin help, counterintuitively help the shelter inflation categories. Now, so the other things are more idiosyncratic. They relate to like healthcare inflation and things like that, which I agree that the Fed has less control over.
So Tiffany, after looking over that CPI report today and given your view of the economy and of course the stock market, which continues to work, what do you think the Fed's move is next week? Do they cut? Should they cut, Tiffany?
Well, I think what the Fed is trying to do and what they, my interpretation of what they've been telling us is that policy is still in restrictive territory. In other words, policy still reflects an economy that, is more closely aligned to the unique pandemic related conditions that we've seen for the last several years. But the problem is that the underlying economy and the fundamentals are no longer in those unique conditions. We have an economy that's returning to normal, and yet policy rates are still set in restrictive territory. So I think what the Fed is trying to do is they're just trying to correct that. And so they're doing a sequence of rate cuts to more align monetary policy with the state of underlying fundamentals. And I think that's good. And as a result of that, they will probably cut another 25 basis points at their December meeting next week. But I think at the same time, though, there's no real urgency to cut. The economy looks good overall. Inflation, it's coming down, but it's coming down only gradually. So I think they will probably signal with that central bank cut, they'll signal that they're going to slow the pace of cuts and could slow the pace of cuts quite dramatically in 2025. And by the way, when you're more uncertain about policy and Washington policy and where that's going to land, what you should do is just slow down and see how things evolve. So I do think they probably will, increase their expectations of their rate path forecast for 2025 and really signal they're going to slow the pace here.
Tiffany, does that imply sort of we go from data dependent to policy dependent next year? I mean, you mentioned immigration as an important deflationary force over the past several years. And of course, the concern is that it's going to reverse and therefore provide an inflationary force over the next year. But everybody's having a hard time getting their arms around and what actually is going to happen.
Yeah, I think inflation, the inflationary effects of immigration is actually quite nuanced. And so we actually think they were not deflationary or disinflationary, at least not obviously so. And the reason is because when you have immigration, surges of immigration, into the United States or other places, it raises both labor supply to the extent that these folks are actually getting into the labor market, but it also raises general economic demand, right? As soon as folks cross the border, they have to demand things. They have to demand shelter, food, other things. And so it has raised demand as well. And so when you have both demand and supply that's increased, it's actually not obvious what the impact on inflation has been. I actually mentioned, we think it's boosted shelter inflation because you can't, build new affordable housing as quickly as these folks were coming in. So you didn't have a supply side reaction there. I think it's certainly possible that, it has increased the unemployment rate. So we could get some, moderation in the unemployment rate. We'll see the effects on wages. It's not so obvious to us. Maybe there are certain sectors, like construction or agriculture or things like that, where you have had a bigger disinflationary wage effect. But overall, it's not so obvious to us. But to get to your broader point, is the Fed going to be policy dependent? We think yes. The Fed has to take fiscal policies as a given, and they have to set monetary policy in a way that meets their dual mandate goals, given that fiscal policy background. So we do think they will be waiting, to see how fiscal policy evolves, trade policy, immigration policy, et cetera, and they will try to be setting monetary policy accordingly.
Tiffany, great to catch up with you. Thank you so much for joining us.
Great, thanks.
Now, time for some of today's top trending tickers. You can scan the QR code below to check out the best, worst, and most traffic stocks of the session on Yahoo Finance's trending tickers page. First up, we've got to look at Apple, which, as we mentioned, is at a record today, as well as Broadcom, or Apple did touch a record, we should say. The companies are reportedly teaming up to work on an AI server chip. That's according to the information. Here with more, Yahoo Finance's Dan Howley. Now, we know Apple has been exploring diversifying its chip supply chain, including making chips itself. Mm-hmm. How does this fit into all of that?
Yeah, I mean, look, this is right in its wheelhouse, essentially, right? They started building chips with the iPhone. They have chips now on the Mac, the MacBook, and the iPad. They don't make, they make all of the chips for their main computing devices, including the watch as well. So it's not as though this is completely far afield for them. I think the interesting thing is that this is going to be so geared towards AI. And this comes at a time where Apple is really kicking up its AI capabilities. They just today launched iOS 18.2 and iPad 18.2 and Mac OS 15.2. Those all include additional Apple Intelligence capabilities, whether that's ChatGPT integration or visual intelligence, which allows you to do visual search using your iPhone 16. No other iPhone yet. But this is all something that Apple is just going to have to deal with because according to this report, they're still using Mac level chips to run these AI capabilities. And so that's neither powerful enough or energy efficient enough. And so if they can build their own chip that allows them to cut down on energy usage while also being powerful enough to provide the capabilities that they need for future Apple Intelligence features, then it just makes sense for them to do this. And as I said, they're putting together chips already that are, I mean, mind-blowing as far as power efficiency and performance. And so if they're able to do this at a server scale, I mean, man, you could just imagine what Apple will be capable of. Don't expect this to go to any other companies, though. This isn't going to be something that they end up selling. They're not taking on Nvidia in that respect. It's just going to be an internal Apple product.
Dan Howley, thank you, my friend. Good to see you. Turning to shares of Mondelez as the company approves a $9 billion buyback, and this comes as Hershey's main owner reportedly rejecting a preliminary takeover from Mondelez. So this was interesting, Julie. Yes, Mondelez does approve this buyback. It's effective January 1st. That then to some raised doubts about a deal here because the company did reportedly make this approach to Hershey. The trust that controls the company apparently rejected that bid as too low. So some saw the capital return news and said, okay, well, these reports, this idea that an acquisition was in the works for the candy maker, maybe off the table here.
Yeah, but then there are some who are saying, well, maybe it's not entirely off the table. Mondelez tried to buy Hershey before, and the same thing happened. The head of the trust said, no, we are not interested. What is different now from then? Well, there's a new CEO, a different CEO of Mondelez, a different CEO of Hershey, and a different CEO of the trust that controls Hershey. In addition to that, the companies are a little more stretched than they were. We have seen costs for things like cocoa go up, for sugar go up. So it may be that the conditions are better. Obviously, that was the bet that Mondelez was reportedly making initially with the approach. So we'll see what ends up happening this time.
I think in part, too, people were looking at this commentary from Mondelez where they were saying their capital allocation priorities include reinvesting in brands and acquisition strategy that's focused on bolt-on assets. And people look at Hershey and say, well, here we have a company market value north of $40 billion.
Right, that's bigger than a bolt-on.
Debt per Bloomberg. Does that sound like a bolt-on?
Yes.
That's what they got.
Maybe not. Taking a look now at healthcare, lawmakers introduced a federal legislation that would make healthcare companies with pharmacy benefit managers divest those businesses. Here with more, Yahoo Finance's Anjali Kamlani. And PBMs, as they're called, pharmacy benefit managers, have really been under fire in Washington. But there's been no actual action until maybe now.
Yes, this is the first really concrete step, and it comes after years of reporting and investigations by federal agencies about the impact of PBMs on independent pharmacies in particular. We know that those pharmacies have suffered in light of PBMs, which are owned by large insurers, getting a little bit of an edge over the competition and being able to essentially keep the money in-house, if you will. So PBMs, what they do, just to recap, they basically negotiate with drug companies and provide discounts to get favorable placing on what is called a formulary. That in turn is where patients are directed once they get their diagnosis, and based on insurance coverage are sort of directed towards specific medicines. So what this bill does is it says, in quote, it shall be unlawful for any person to both directly or indirectly own a pharmacy and directly or indirectly own an insurance company or pharmacy benefit manager. And the reason why that is coming up is because we have companies like CVS that not only own a retail pharmacy, but also own a mail order pharmacy. United Health, another big one, with its mail order business along with the PBM. So what we're seeing is co-sponsored by unlikely teammates, Josh Hawley and Senator Elizabeth Warren, looking at making this possibly come out by next year. If you take a look at the market share of these companies, for example, CVS, the largest PBM specialty pharmacy provider, as well as retail pharmacy, 21% of the market share there. United with its Optum Rx PBM at 20.8%, and then Cigna with its Express Scripts. And then the fourth one is not a publicly traded one, so we don't get to talk about it a lot. But Prime Therapeutics, which is partnered with about 18 Blue Cross Blue Shields around the country, is another major player in that pack. Now, looking at what the bill does, it asks for these companies to divest their pharmacy businesses within 3 years of enactment, if it passes, of course. And we don't expect to see this pass by the end of the year. This is potentially setting up for a fight next year in Congress is what we're seeing. Now, important to look at what the companies have been saying. They've already, of course, been defending the role of middlemen. They, similarly to the way insurers defend their practices, they've been defending PBMs as a way to help control costs within the industry. We have spoken to some experts just this week in a wider-ranging conversation. The CEO of Oscar Health told us that the PBM is a tool of the past that needs to be sunset. So even a long-time industry veteran like Mark Berolini is saying something like that, and we've heard that from other experts within the industry. And just as a point of note, CVS Caremark, about 30% of CVS revenue. Optum Rx, also 30% of the big company's revenue. And then Cigna, a little bit more than that. It actually is a bulk of Cigna's revenue.
And just very quickly, Anj, the timing of this, the introduction of this bill coming just, a few days after the killing of the United Healthcare CEO, at a time when the industry is sort of, on the defensive or concerned about public sentiment. What do we make of that?
Yeah, it is interesting timing because it is at a time where the public sentiment is in the favor of these lawmakers, and you find that the industry is largely being quiet as well in the face of these attacks. They're very scared. The executives of these companies are laying low, I've been told, because they don't want a target on their back. So maybe it is the most opportune time for these senators to go after them.
Switching gears on, but sticking in healthcare, Walgreens reportedly in talks to be taken private. What's the latest there? I would imagine analysts are weighing in.
Yes, they are. We got a bunch of commentary. We have to remember this isn't the first time that private equity has been knocking on Walgreens' door. That's actually a specific quote from one of them. So this is something that we've seen happen, and we already recapped yesterday that throughout the year there have been different offers and parts of the business. Morgan Stanley did say in a note that a buyout is harder to contemplate given its already sizable debt burden. That's referring to Walgreens and paltry cash flow, making the value creation pathway harder to decipher. And so that's where the confusion comes from a number of other analysts that don't see this as a slam dunk. Meanwhile, Yahoo Finance has been told that the Sycamore folks are on the ground speaking, and that this is a very serious consideration for the company to go private. So it's going to be interesting to see how Wall Street reacts to that, considering it was very favorable, and every time there's been deal talks, it's been favorable to the stock. But we'll have to wait and see how it pans out.
We will, indeed. Thanks so much. Appreciate it. Well, shares of GE Vernova higher today after raising its multi-year outlook. Next, we're going to hear from the company's CEO. Stick around. Much more market domination still to come. GE Vernova hosting its investor day yesterday, announcing its first dividend since the company spun off from GE in April. The stock has more than doubled since then as energy demand grows from the AI data center boom. Joining us now, GE Vernova CEO Scott Strazik. Thank you so much for being here.
Julie, thanks for having us.
So you guys set some new targets for your growth, whether it's revenue, EBITDA, free cash flow. In terms of revenue growth, you guys are looking for as much as $35 billion this year, as much as $37 billion next year. And I guess my first question would be, why not more, right?
Yeah.
Because we are hearing about all of this growth in data center demand and energy demand more broadly.
You bet, Julie. Our customers are asking us the same question, because if we could build it faster, they'd take it. So that revenue could be higher in 25 if we could just ramp up production. But the reality is a lot has changed in this market in the last 9 months. Things that we were talking about as market opportunities quickly now are our reality. I mean, we need all forms of electrons we can produce. And we're ramping up our production of both gas turbines in Greenville, South Carolina, investing in our nuclear business in Wilmington, North Carolina, ramping up our onshore wind nacelle facility in Schenectady, New York. But it takes time to meet that load growth. So we'll see a much faster acceleration of our revenue in 26 and beyond. We just need a little bit more time to get the capacity ramp. But that 35 to call it $37 billion next year, we see a clear pathway to at least $45 billion of revenue in the next few years. So there's a lot to look forward to.
Gotcha. So right now, capacity is the constraint. Demand is not the constraint.
Demand is not the constraint at all. Certainly not in grid, certainly not in gas. They would take as much equipment as we could produce right now.
Gas turbines, the gas business has obviously been going big. You said you're having a lot of fun, or gas
Yes.
businesses are having a lot of fun right now because of the demand. What's the runway then for gas, particularly right now?
It's going to go for a while. At the end of the day, we're already talking about new capacity into the end of the decade that's going to get added. A lot more demand will happen in the U.S. throughout the rest of the decade. And then that install base is going to continue to run. I mean, you think about the U.S., and between 40 and 45% of our electricity comes from gas power today, and we're about to go into a real load cycle. In the rest of the world, that number is closer to 25%. But as other parts of the world shift, like the U.S. has shifted with things like coal to gas, the proportion of gas electricity will only grow.
And the conversation in the U.S. has really shifted, it feels like, over the past few years with regard to energy, in part because of that huge demand from hyperscalers and related to AI.
Yes.
Where it feels like that there is now a sort of, we'll take anything we can get approach, less
Yes.
of a real emphasis on renewables. What do you think about that? Is that the right approach, and how are you guys sort of meeting that?
The way I would frame it is the focus on sustainability ultimately hasn't changed at all. But at the end of the day, there is a need for more electrons sooner. And a lot of the customers, including the hyperscalers, are saying, okay, I need more electrons this decade, but I also need to understand how I'm going to decarbonize those electrons in the next decade. So we spend a lot of time talking with them on things like hydrogen consumption in gas turbines, carbon capture attached to the gas turbines to decarbonize them, small modular reactors, and ultimately how we build out systems of systems that includes more wind, solar, and storage that meets their needs over the long term. So I wouldn't say sustainability has taken a back seat to electrification. Both matter. But in the near term, we're in an arms race to kind of compete with things like AI, and gas is an incredible scaled solution for this decade. But a dollar invested in gas isn't a dollar invested in carbon forever. We'll decarbonize that gas. And candidly, I think the hyperscalers are really going to help us with that because they're going to force technologies to the left because it's such a huge priority for them.
Wind, you mentioned, that is, at least on a relative basis, a weaker part of the business.
Yes.
What's going on there? Why is that? Is it a matter of manufacturing? I know there have been some friction on that front, or
Yes.
is it on the demand side?
Both. Okay. But I would also say the demand is somewhat impacted by the industry's quality performance. When I compare the wind industry to the other parts of our businesses, it's the least mature supply chain. It's an industry that needs to grow up from the perspective of safety and quality and get to a level that we can industrialize at scale products that work. The reality is the wind industry went through so much growth over the prior decade. There were so many serial variants of products that were delivered. we didn't harden what we have enough, and that is the we as in the industry. I think the industry is now understanding that and needs to really develop what we talk about in GE Vernova as workhorse products that at scale will work. As that happens, the world needs wind. I mean, today the world only gets about 10% of its electricity for wind. We need that number to be closer to 25%. The only way we're going to get there is with a more mature supply chain, and I think we're in the early stages of that, but we'll get there.
You mentioned SMRs, small modular reactors,
Yes.
all the rage to talk about.
Yes.
But of course, none of them actually exist, and they won't exist for a few years
That's
here.
right.
So what is the timeline, and what's your confidence level that they will actually exist and that they will be successful as part of the grid?
Confidence interval very high. We have 65 boiling water reactors or 65 nuclear plants in the US that are running with our technology, about half of them with the boiling water reactor combustion technology that we're using for the small modular reactor. We know how to do this. The nuclear combustion technology exists. The fuel supply chain exists. The licensing, the permitting, to a large extent, there's a very clear pathway to do it. We'll be in construction on our first project in Ontario, Canada, next year, and it will commission the first electrons in 2029. We'll follow that in the US early in the next decade. I think 2032 is a practical goal, and then it'll scale from there. So relative to some other things we can talk about, 2032 may feel like a little while from now, but we're going to need all of the above for a long time.
Yeah, and it'll go more quickly probably than we think. When it comes to the SMRs and development of new nuclear developments, there's been a lot of optimism that this incoming administration is going to be more friendly to the industry. We've talked to some of the SMR CEOs who are optimistic.
Yeah.
Do you share that optimism on the regulatory front? And what are the risks around that sort of less regulatory load?
Well, I wouldn't want to project where the regulatory dynamic goes, but what I would tell you is what I hear from this incoming administration every day is very much an all-the-above energy strategy, a view that energy is going to drive competitiveness, that the innovation that we create in the U.S. will create not just energy security, but national security, and that we can really use energy to export that for the world, not just for economic growth, but frankly for peace and stability in a lot of parts of the world. So I think this administration, we have an opportunity to serve with many different technologies. It does include SMR, but it's going to include gas, it's going to include wind, and we're going to work really hard to serve the administration with all of those priorities, including massive investments in the grid that are coming.
Right. All right, we'll talk about that next time.
I look forward to that,
thank
Julie.
you so much for being here.
Thanks for
Appreciate it.
having us.
Well, a new administration under President-elect Trump has set expectations that deregulation could be ahead, potentially paving the way now for more takeover deals. The options market providing one-way investors could read the signs of which companies may be caught in the takeover arena. Chris Brecher, Simpler Trading Senior Managing Director of Stocks, joins us now to discuss in the options pit, sponsored by Tasty Trade. Chris, it's good to see you. So the options market can perhaps provide traders, investors clues about which companies could be takeover targets. Walk us through that, Chris, and which companies are showing up on your radar.
Well, I'll show you the first two that are hindsight trades. Is showing the increase in implied volatility in Walgreens and Hershey's prior to any rumors or announcements. Both of them had persistent call buying for weeks, and it was sort of shown in the implied volatility. So you could see it that a consistent accumulation of calls in both of them. And that came out with the implied volatility that if you put IV on any chart and overlay it with the stock, you'd see on how much different it was with Hershey's and Walgreens prior to any action.
And I guess why is that, Chris? Like, what if do people just get inside information? One person does something and then everybody kind of chases that, or how does that work?
Well, I've been trading the takeover stuff for, well, now it's 44 years. And when I was on the CBOE, what happened was you'd get, let's say, a broker come in and buy like the offer on a call and go buy them. And you go sold. He's like, I have 5,000. It's like, oh my goodness. So then you have to go buy the stock. But you see somebody coming in like that, And then you're like, well, I better get in also, sort of like Trading Places on how they were then. So usually you start seeing an accumulation, not like one lot, not like 1,000 lot of one block. You want to see 50 and then 50 and then 50, and you want to see it over a period of time. And you can see that you saw it in Hershey's, where one day, let's say it trades 1,000 options. At midnight is when they adjust the open interest for the next day. So if you see 1,000 and there were only 200 options open interest the day before, and now it's 1,200, you know they were buying them to open. Also, if the implied volatility is going up, you then obviously they're buying them. So if they were selling it, the IV would be going down. So it's the persistent call buying that you see. And in answer to your question, who does it? There's so many chains of command. Like now, you have a lot of people saying the new administration is going to help with takeovers, like you mentioned. And then you have a law firm that came out and said they're getting so many calls about potential takeovers. And then you think about how many people within that chain of command are hearing this stuff. So and if you go in lax regulation, you can do unusual option activity. You're probably not going to have anybody say anything. So it's a great time to see unusual option activity because, like I said, you go and buy them if you have some inside information. In certain administrations, it's been going on for 44 years, all shapes and sizes, Democrat, Republican, it doesn't matter. If it appears to be lax regulation, you get a lot more unusual option activity prior to an event.
And are you seeing that, Chris? You mentioned Hershey. Are you seeing that kind of unusual option activity right now and some new names?
Yeah, there's one, Insumed. I don't even know what Insumed does. All I know is it's in the medical area. And I've been watching that the stock has really done nothing for about a month. But the January 80 calls have gone from a 2,000 open interest last month, like 25 days ago, to 8,000. And like I said, that could be sellers. You might say, how do you know they're buyers? Because the implied volatility has consistently gone up since that increase in open interest. So Insumed is one of them. And my theory is next year, a lot of these high flyers, the Googles, the Amazons, I know, you got regulatory problems with the Googles and all that if they try to buy somebody theoretically. But some of the other big ones, I think they're going to try to use their high price stock to buy some of the others in the tech arena, like the MongoDBs and the Cyberonics and the PANW. The sweet spot to me I've seen is about 5 billion to 40 billion in market cap is about it that you can take over. Probably another one to watch, even though it doesn't have the chart yet. I like to combine it with a chart pattern. And Hershey's and WBA had good charts prior to any news. Fastenal refuses to go up, but the options refuse to go down. So if I start seeing like an hourly bullish pattern develop in there, I'm probably going to go and buy some out of the money call spreads going into, let's say, January.
Chris, thank you for your time. We appreciate it.
Sure, anytime. Thanks again for having me on.
Stick around, much more market domination still to come. Shares of Alphabet on track for a record close after hitting a 52-week high. Company introducing its latest model, Gemini 2.0, a day after revealing its new quantum computing chip. And Aaron Kessler, Seaport Research Partners senior analyst, joins us now to discuss all this. Aaron, always great to see you. So let's start with that news we got today, Aaron. You know, Google did unveil a new version of its flagship AI model. I'm just curious what, as a financial analyst, walk me through what you made of that headline, that news, and what it possibly means for investors.
Yeah, no, I think it shows that Google continues to be the leader in AI services. Obviously, Google's been investing in AI for several years now, and it was one of the early leaders. I think there was concern, obviously, with OpenAI maybe jumping Google in terms of with ChatGPT, but I think Google's had a nice rebound here with tools like Gemini. Obviously, we saw the quantum computing announcement yesterday. So despite maybe not getting off to the best start, Google's really come back pretty strong on some of these new releases. Still early in terms of maybe consumer adoption of some of these services, but clearly they're seeing strong growth in their cloud business, 35% growth last quarter. And we think AI has been a leading driver of that cloud usage as well.
But Aaron, you know, we knew about that stuff, right? So like, is it the quantum and Gemini stuff that is boosting the stock? I mean, we've seen pretty forceful run over the past couple of days. It's trading at a new record. Is that what's going on here?
We think it's probably a few things. We don't think it's just this, which is probably somewhat immaterial in terms of today's announcements. We think it's, I mean, you've seen a nice recovery in the FANG names over the last couple of weeks, maybe that rotation back into some of the FANG stories. Obviously, Google was oversold in our view when it got down to the 170 level. So it kind of got overly punished there, we think, on some of the regulatory concerns. And maybe investors are saying with the new administration coming in, less likely maybe we see some DOJ action in terms of really splitting up Google and Chrome, which we think is pretty unlikely. You saw, I guess, with GM, with Cruise getting out of these autonomous vehicles, it's in our view, it's kind of really Google's with Waymo, as well as, I guess, Tesla market to lose at this point as well. So I think investors are increasingly getting more positive on Waymo, even though it's a relatively small part of Google's valuation at this point.
You know, Aaron, earlier this year, there had been some concern in some quarters about just general rising search competition. You know, there was this idea, well, AI is going to upend and disrupt Google's bread and butter. Has your research, have your checks, survey work, Aaron, has it shown any real meaningful slippage in Google's share there?
Yeah, it really hasn't. I mean, we've seen obviously very strong search results from Google, double-digit growth again this year. We're looking for roughly 10% growth again in 2025, but really haven't seen any meaningful degradation in search market share. Something we'll continue to watch with companies like Perplexity or ChatGPT. We think, and some users, early adopters, are clearly using these services, but until it really expands beyond kind of early adopters into more mass market, we're not overly concerned at this point. And even if it does, and Google's, I mean, obviously Google will have a strong position with AI search as well.
Aaron, it's interesting that you mentioned Waymo, right? And their sort of runway there. It is relatively small, and yet, you know, fewer people are talking about that than they are about this other stuff like quantum that's years into the future here. What do you think is the potential of that Waymo business, even though it is relatively small?
Yeah, no, I mean, right now, we think most analysts are looking at maybe a $40-50 billion potential asset. We think it's really years away in terms of revenue scaling into that size to make sense of that valuation. But clearly, it's really Waymo's business to lose right now. And we expect them, as they indicated the other day, they're going to be expanding more aggressively in 2025 into newer cities, getting up to 10 cities or so. I think if you've taken a Waymo before, you kind of realize that it really is going to be most likely the future of taxis or taxi services.
So, Aaron, let me ask you. You know, listen, you're bullish on the name. You got to buy. That's what you tell your clients. This stock has had a tremendous year. You know, it's up around 40%, Aaron, in 2024. When you talk to your clients and they ask you, okay, it's a buy, Aaron, but what's on your list of worries? What's on your list of concerns? I mean, is it valuation? It doesn't sound like you're too concerned about regulation. What would be on your radar?
Yeah, not valuation. We think valuation's always been fairly attractive on Google. Even with the recent run, you're looking at 20 times core earnings, and these core earnings are growing, we think mid-teens right now or so with search and kind of YouTube, et cetera. Obviously, if they actually were forced to split up Chrome from search, that would be a concern. We don't think there's a high likelihood of that. And if we were to see search share losses to some of these new upstarts, that would be a concern, but we don't think we're seeing that yet, as we talked about. So I would say either search share market losses or actual DOJ action on their core business. We think it's a good likelihood you get some of the ad tech assets are split up. We don't think that's a big part of Google's valuation today, though.
Aaron, always good to see you. Thanks for taking the time to join us.
Great, thank you.
And while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
There is the closing bell on Wall Street, and now it's Market Domination Overtime, sponsored by Tasty Trade. We're joined by Jared Blickery. He's going to help get us up to speed on the action from today's session. We start with the major averages right now, and we are looking at potential records here for those majors. The Dow, though, lower by more than it was an hour ago, now off about 1/5%, almost 100 points. The S&P 500 rising 0.8%, but it looks like it is not quite back at a record close here. And the Nasdaq has been roaring ahead, really leading the pack, not just today, but in recent days. We see records for a lot of the Magnificent Seven, as well as that strength in large cap tech is really pulling everything higher. 1.8%, that gain for the Nasdaq on the day. Jared's got a closer look at all of the action today. Hey, Jared.
It was a day of mega cap action. We do have some records. We have the Nasdaq Composite and the Nasdaq 100 at records, not the Dow. Dow was down today, as you said, Julie. Here's the Nasdaq Composite, and let's just check out the intraday price action. Gapped up, and it was just a slow slog to ever increasing highs, and we're just off those highs, but very slightly into the close here. And let's also take a look at the Nasdaq 100. That's up almost 2%, and we'll also take a look at the Nasdaq 100 equal weight, up 1%. But it was also a day when we saw the bond market moving, and that comes after that CPI, and the direction is up. 5 basis points is not nothing. 4.27% is not nothing. Here's the year to date on the 10-year, and you can see we are kind of in the middle of the range for the year. Here's where we are right now. We are off of the lows here, off of the highs here, and so kind of an indecision area. And we also want to take a look at the U.S. dollar index. That is relatively near its highs of the year, but it is not at either those highs or the lows in the recent range, so we're not going to consider that as a big market force either. Here's the sector action, and as I say, it was all about the mega caps. Here we have consumer discretionary, XLY, that's up almost 1.75%, or just a little bit more than that. Communication services and tech round out the top three. What did not work today? It was defensives. It was healthcare, it was staples, it was utilities, each of those down more than 0.5%. And let's get to the Nasdaq 100, where, guess what? Drum roll, we got Tesla at a record high. Bye bye 420. We're at 424.77. Here's a 5-year chart where you can see here are the old highs in 2021, rocketed past them today. And let's just see what's happened over the last month. Basically, since the election, up 21%. Over the last 2 months, up 95%. That includes more of the post-election action, like right in here. So that stock has almost doubled since the election, which is pretty impressive. Apple, no record high today, though it's been on a streak recently. Not for Nvidia either, but Meta, Alphabet, Amazon, each of those notched record highs. And I should say that Alphabet up 5.5% today. Josh?
Thank you, Jared. OPEC has revised its oil demand projection downward, citing sluggish economic activity in several regions across the globe. And joining us now with more is Yahoo Finance's Inez Ferre. Inez.
Yeah, Josh, and OPEC cut its demand growth forecast for the 5th straight month for 2024, also cut its projection for next year. The Oil Alliance cited weaker demand from the top importer, China, as you mentioned. Also, non-OPEC supply growth also playing into the group's projection. But keep in mind that China's recent signals to stimulate their economy, that's expected to be bullish for oil. So today we saw that oil went higher today, and in part this is because of some EU sanctions against Russia. This would be the 15th package of sanctions on Russia over the Ukraine war. These sanctions target what are called Russian shadow fleets. Those fleets bypass that $60 per barrel price cap that was imposed by the G7 group back in 2022. And it has helped keep Russian oil really flowing. This would be a clampdown on those flows. That's why you saw oil today up more than 2.5% for WTI. Brent crude up almost 2%. If we just take a look at a year-to-date chart, we're seeing that Brent is down 3% year-to-date. WTI is relatively flat for the year. Today's price action was capped by some rising U.S. inventories of gasoline and distillates, guys.
Well, and speaking of gasoline, how is all of this expected to affect gas prices?
Yeah, so we have seen some volatility when it comes to oil prices over the last several weeks, but analysts are expecting gas prices to come down below the $3 per gallon threshold in the next few days, or by the end of the year, basically. So you're looking at gasoline right now that's at $3 0.02. AAA is saying that you can expect this to come down to that level of the below $3 level, and this would be a 3-year low for gasoline. So we have seen a steady decline of gasoline prices throughout the last month or so. We've seen a little bit of volatility over the last week, but it may be a good Christmas for drivers. Slower demand really because of the driving season, and just a slowdown in demand when you're looking at gasoline as well.
All right, thank you, Inez.
Thank you.
Tech stocks were the standout on Wall Street today. The Nasdaq closing at a new all-time high, and 5 of the Magnificent 7 stocks hitting record intraday highs. And our next guest says even with this recent rally in the Mag 7, there is more room to run for some of these names. Joining us now is Dave Mazza, Roundhill Investments CEO, which runs the Magnificent 7 ETF, MAGS. Dave, always good to see you on set.
Thanks for having me.
So let's first of all just talk about the moves we are seeing today with these big tech names. Why are we seeing these moves, Dave? Why are they working this? I mean, should I chalk this up mostly to money managers chasing performance here into year end? Is that what's happening?
I think that's certainly playing a part of it, right? Is that people don't want to be on the wrong side of what has been for 2 years an incredibly impressive trade. And especially this year, many people were expecting there to be that broadening out. We've heard a lot about these small cap rallies and they all fizzled out. But people come back to the Magnificent 7 because they, in this market, have been providing both offense and, interestingly enough, I think most recently, some defense here, right? So we saw huge gains post the election, definitely broad-based, and now people are reassessing and saying, hey, what actually companies are going to be able to kind of power through whatever we see out of the economy and whatever we see out of the Trump administration?
Well, and speaking of the Trump administration, one of the other interesting things that we've noticed is that the Magnificent 7 rally didn't really start with the election. There was sort of a lag, and then it took off. So it's sort of curious what everything you're saying might be true. It's still hard to sort of find what the catalyst was for this latest move upwards.
Well, so I think this most recent move is certainly really robust, and it has pulled forward some of the returns that we were expecting to see in 2025 into 2024. And by that I mean, we still had a positive view on the Mag 7, on the markets in general, but a lot has come in a short period of time, to your point. But some of it I think comes back to the fact that these companies as a whole, right, not all of them, not at all times, really have impressive operating leverage, so they're able to grow their profits really, really fast. And when there's questions about what exactly is going to happen on the tariff side, is inflation going to continue to cooperate? It certainly did again today, but there's no guarantee that's going to continue to be the case. What kind of companies are going to be able to power through that? We know that industrials and banks, I think, are going to benefit under the Trump administration, but it's not as if in either or situation where we can't see these market generals continue to lead the way higher.
And Dave, as a group, what does earnings growth look like for these big tech names next year, 2025?
Well, it's interesting. So earnings growth actually is better than the rest of the 493 for the first quarter, for the second quarter. It isn't really out until the back half of 2025 where we see more of a moderation, where actually you see the Mag 7 earnings growth on a quarter-over-quarter basis begin to decline and the rest of the market pick up. Because I think there still is a general sentiment that the economy is okay, and we have so much positive investor sentiment now, and that to me is really what's pushing the market higher, right? If we look at Tesla, for example, you're talking about it kind of heading into this segment, the gains are huge, right? And this is a stock that people kind of wrote off for dead for some time because of all the issues with Elon Musk and others. And again, investors have come back to it, and really, I think a lot of that, though, happens to be from the sentiment side, because it's not like we've necessarily seen much different news when it comes to deliveries and orders and things of that nature.
Yeah, I'm curious about the other risks to the Mag 7 too going into next year. Besides the sort of relative growth profile, there's certainly regulatory overhang still for some of these names, Alphabet being one of them. We just talked to an analyst a little while ago who said he doesn't think that Google's going to be forced to sell off Chrome, for example. But even so, there's some uncertainties around some of them.
Yeah, no, well, Alphabet is a great example, right? So that's a stock that's sort of kind of been a laggard in the Magnificent 7 group, and maybe you could say actually been a laggard sort of across a broader market, depending upon your perspective. But it's actually been building a nice base. It's found support at its 200-day moving average consistently. And yeah, I think the regulatory overhangs on that stock aren't going away tomorrow. There's still questions about about what the new FTC commissioner is going to do when it comes to big tech. It seems clear based off of Trump's post on his social media network that that's an impetus for this chair, continue to be focused on free speech and things like that. But I don't think the worst case scenarios for Alphabet will come to fruition. So I would agree with that.
Are there certain names, Dave, that you find more compelling, interesting here than others?
An interesting name that in the Magnificent Seven group that has been a bit underappreciated, that has been building a very long base, is actually Amazon. Now, Amazon is a company that has, of course, we focus on it at the retailer side, but it's really an AWS story. And as companies kind of continue to support growth in cloud, it supports that, even though many people are kind of look to move into that space. Plus, they're a hyperscaler when it comes to AI. So I think that's a name that's been a bit underappreciated because Apple kind of caught its AI bid with the integration of Apple Intelligence and Siri, and now we have news that they're integrating ChatGPT into that. But Amazon actually has a lot of firepower on the AI side that's not as appreciated to the same extent.
Well, now it's getting appreciated because the stock closed at a record today.
Yes.
So I guess people are catching on. Thanks a lot, Dave. Good to see you. Let's get to shares of Adobe. The company's numbers just coming out a few moments ago, and the forecast is pushing the stock down here. This is the 2025 revenue forecast specifically. Adobe predicting $23.3 billion to $23.55 billion. Analysts were looking for closer to $23.8 billion. So the whole range of its revenue forecast is below what analysts had been anticipating here. I believe the 2025 earnings per share forecast might also be a little bit short here. That said, fourth quarter earnings beat estimates at $4.81, and revenue did as well. So it's more just the outlook here for this current year, or I should say next year, that is below what analysts have been predicting. Josh?
Yeah, it has not been an easy year to be long this name. I mean, heading into this print, Julie, the stock was already firmly in the red for 2024. Now we're at least initially in the after hours, heading lower. It's interesting. I mean, the concern has been around what some think is this sort of existential threat, really, around AI, the competition from companies like OpenAI, which made news this week. To be fair, others say, listen, AI is actually going to be an opportunity for CEO Shantanu Narayan as he now sort of layers in new AI capabilities into his products like Firefly. We do have comments from Shantanu Narayan here talking about how his company delivered a record 2024 revenue. He talks about strong demand, mission critical role of Creative Cloud, Document Cloud, Experience Cloud in fueling the AI economy. So trying to sound obviously a positive economic tone here, but initially investors don't seem impressed.
Yeah, I mean, and the growth that the company saw, I mean, it is still seeing growth here, I should say. So 11% growth year over year in revenue. Digital media revenue was up 12%. Digital experience revenue was up 10%. So it is still seeing that growth. And as you say, some defenders of the company have said that it's not, that it's incorporating the AI tools rather than being threatened by them. But the market definitely has spoken.
We'll wait for the call. Coming up, it is what to watch for tomorrow. We're going to get you set with everything you need to know to kickstart your trading week. Stick around, more market domination. Overtime coming up.
Yahoo Finance has been releasing its coveted annual Company of the Year award since 2014. We'll reveal a winner in the following categories: Company of the Year, Surprise of the Year, Product of the Year, and Comeback of the Year. Be sure to tune into Yahoo Finance starting December 16th for the big reveal. Trust me, you won't want to miss this stuff.
Welcome back to Market Domination Overtime, sponsored by Tasty Trade. A new book coming out chronicling the history of the chip designing juggernaut Nvidia and the company's culture, overseen, of course, by co-founder and CEO Jensen Huang. Joining us now, the author of that book, Tae Kim. He's senior technology writer at Barron's. And, you know, obviously everyone now is obsessed with Nvidia, Tae. But you started looking into this and started working on the book just before the sort of most recent explosion in the shares and in interest. So talk to us about how that sort of came about.
Well, I just got lucky. I got a cold email in my inbox of May of last year as an editor from Norton, and he said, oh, I know Matt Ball, he was the author of ours, and he recommended you to write the book. And the first thought I had was, there has to be a book on Nvidia. I went to Amazon, looked it up, and there was none. I was stunned. Like every other big tech company has 4 or 5 books, and for some reason, no one has written a book on Nvidia. And even at that time, it was still the biggest chip company in the world. It had some success. And then, boom, a few weeks later, they had one analyst called the biggest upside quarter he's ever seen in history. And then we've had these 5 or 6 quarters where they're growing triple digits at a revenue number that has been unprecedented in the history of the computing industry. So it's been quite a ride. I've been lucky to talk to all the early senior management, employees, competitors, and everyone is thrilled to tell the story because it's one of the best stories in American business history. There's no doubt in my mind about that.
And Tae, let me ask you, because you look at Nvidia and the success they had, and Jensen he's got a lot of really smart engineers, got a lot of money, but there's a lot of tech companies who have a lot of smart engineers and a lot of money. What do you think explains Nvidia's great success? I mean, as you say, you know, one of the great stories, right, in American entrepreneurial history. What is it? Is it Jensen? Is it his leadership? Is it the culture?
It's all of the above. Yeah. You just nailed it. We have this extraordinary outcome where Nvidia is literally the best performing stock in US history with any company with 20-year returns. If you put in $10,000 at its IPO in 1999, it will be worth $40 million today. So what explains that? And you nailed the key hallmarks of it. And it's the culture that Jensen was able to create. It's the work ethic. I had this story in the early 90s where this one employee, she worked after midnight and said, oh gosh, and she slept for 3-4 hours and then woke up at 4 a.m. and she was thinking, oh, I want to go back to bed, but no, I have to go kill Intel because Jensen just gave an inspirational rally cry that we must kill Intel because they're out to get us. And this is when Intel was trying to snuff them out. The second component is the talent thing that you said. Jensen is obsessed with finding the best talent. He will interview someone, ask them, who are the best people you work for? And people will just tell him. He will pocket that memory, and 2 years later, go after that person and recruit. And he's relentless. He recruits the best people, and they usually say no the first time, but eventually he gets them. And he's also great at retaining people. Nvidia, if you look at their annual filing, their turnover is only 3%.
Which is remarkable, Tae, because given the jump in that stock, there's a lot of people in Nvidia who've made a lot of money. I mean, you would think there'd be some significant folks who are like, I can spend the rest of my life spending at this point.
They retain a certain type of people. I'll call them mini Jensens, who love, Jensen is wealthy beyond his wildest dreams, right? But he still works every day of the week, crazy hours. He's working Sunday evening with his Highland Park scotch, drinking, reading hundreds of emails. These are people that, wealth is great, but they're driven by a passion to work, and it gives them satisfaction. He loves working. He says working is relaxing. When he goes to a movie, he doesn't remember the movie because he's thinking about work the whole time. So all these people, all the senior management teams, a lot of them have been there for 25 years. These are people that are driven by the mission, they're driven by the passion, especially now. In early days, it was mainly video game PC chips. Now it's the AI stuff they're doing is changing the world in every single sector. One real big sector that Jensen is most excited about is the potential for AI and digital biology. So this is stuff that could possibly cure cancer. This is stuff that really changes the world. So that's how you retain people, if you have a mission and passion to do that.
Tae, I do want to ask you, it's not as though the road has been easy, right? There have been obstacles. The latest obstacle could be China, right? And the company has sort of negotiated and offered lower advanced chips in China to try to avoid some of the regulations. But the latest reports that they could be facing an antitrust investigation in China. Given what you know about the company, what you've learned, like how do they attack issues like that?
I think Nvidia will just have to listen to what the US government tells them to do. I mean, the US government has put in restrictions on their most advanced GPUs, so their revenue has already gone down. Most analysts are kind of zero outing the China revenue.
Business.
Yeah, because their best, fastest chips, they can't sell in China anymore.
Right.
So I think part of this is just China thinking of this as theater to kind of strike back at the US, but China wants Nvidia's chips. They want Nvidia's most advanced chips. So it's kind of like, what are you going to do? Their chips are already banned. The high revenue stuff, the best stuff is already banned and restricted for export is the technical term.
Right.
So I wouldn't work, I mean, it's already happened.
Okay, thanks for being here.
Thanks for having me.
Interesting stuff. And we'll look forward to checking out the full book.
It's out right now.
It's out. People can check it out. People can get it. Thank you, Tay. Coincheck Group, the parent company of Japanese cryptocurrency exchange Coincheck, making its public debut on the Nasdaq following a merger with a SPAC. The stock rallied in its debut. Executive chairman of Coincheck, Oki Matsumoto, joins us now with more. Oki, so tell us about Coincheck and who your investors are and how large the folks who are on your exchange are, or how many people, how many users, I should say, you all have.
Thank you. So Coincheck is a cryptocurrency exchange in Japan, and we have about over 2 million individual customers using our services in Japan.
Okay, I'm curious, what's next for the company now, right? I mean, in terms of your roadmap, is it expand products? Are you going to invest in infrastructure, security? Walk us through it.
The Coincheck now, the holding company Coincheck Group is now listed on Nasdaq. So we can use our stocks as acquisition currency. So we can acquire our competitors in Japan, and also we can acquire similar businesses around the globe, and also we can acquire other talents, and also Web3, on-ramp, off-ramp, those kind of companies as well. So because it's only Coinbase and now Coincheck who are listed in this kind of community, so that we are one of the only two companies who can provide liquidity. So that will really give us ability to expand our business globally, I believe.
Are most of your users based in Japan, or do you have a pretty global base?
It's only in Japan. So from the regulation point of view, we only services to people living in Japan, except U.S. citizens. If it's U.S. citizens, even they live in Japan, we don't do business with them. So basically, all people in Japan except Americans living in Japan, they are the customers.
Okay, some viewers might remember your company because you certainly made a lot of news. This was a few years ago. I think it was 2018, Oki. You all lost, I think it was something like $530 million in customer assets. At the time, I think it was the largest crypto hack in history. What did you all learn from that experience?
Actually, what happened was they got hacked, and then my company, Manex Group, came in and acquired them. So that happened before we came in. And then we came in and rehabilitated them. We worked with one of the best, strongest cybersecurity consultants in the world. And also we brought in the internal controls and everything. And then we made the company stronger and then grew the company. So that is Coincheck today. So, that hack was unfortunate, but that gave us the opportunity to buy them. And also it gave us the opportunity to make the company stronger. And here it is today.
And so just to build on what now, kind of what your expansion plans are now that you are publicly traded and whether you expect to sort of expand into other countries or acquire other assets, what's the plan?
So as I said, for us to become truly dominant presence in Japan is the one thing we should do. And also, there are lots of synergy or efficiency effect by running this business, cryptocurrency trading business, globally, because custodians are the same, liquidity providers the same. So lots of synergy effect if we run this business globally. So the natural kind of direction is to acquire those assets, not only in Japan, but also any part of the world.
Oki, thank you so much for joining us today, and congrats on the big day.
Okay, thank you so much.
Time now for what to watch Thursday, December 12th. Starting off on the earnings front, we're going to be getting reporting from Broadcom, Costco, and Lennar. Tomorrow, Broadcom announcing results for the fourth quarter after the closing bell. Analysts expecting a healthy quarter for the tech company, driven by a strong wireless segment and continuing momentum in AI and cloud networking.
Taking a look at the economy, monthly PPI data, that's the producer price index, that'll come out in the morning. Economists forecast core PPI for November will slow down to 0.2%. Total PPI holding steady at 0.2% as well. It's coming after today's consumer price index, aligned with market expectations. All this new data will give us, of course, more insight into inflation ahead of next week's interest rate decision from the Fed.
And moving over to housing, weekly mortgage rate data from Freddie Mac is coming out in the afternoon. Last week, rates fell for the third straight week to 6.669% as homebuyers continue navigating a sluggish housing market.
And finally, President-elect Donald Trump ringing the opening bell at the New York Stock Exchange. He's also expected to be announced as Time's 2024 Person of the Year. He was the magazine's Person of the Year back in 2016 when he was first elected to the White House. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. We've got you covered for the next half hour with the latest and greatest market-moving stories, so you can get ahead of the themes affecting your money. Stay ready, tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve, and here are some of the trends we're going to be diving into. It appears the last mile of inflation is going to be the hardest for the economy to run. CPI coming in as expected today with price increases in things like groceries and gasoline, proving inflation remains stubborn. We're also going to take a look at a record-setting day for Apple and several other Mag 7 names. The mega caps performance pushing the Nasdaq to close above 20,000 for the first time ever. And the AI boom has led to a huge increase in power demand, and with that demand comes a need for metals like copper. We're going to explore how mining companies are handling it and what sort of surge we could see in the coming years. Well, Apple hitting another record high today, but headwinds loom over that company with potential tariffs and questions about this iPhone upgrade cycle. So how is the company still powering through all this? For more, we're going to bring in Doug Clinton, founder and CEO at Intelligent Alpha. Doug, it is always good to see you. So let's start with the move we've seen in Apple, in that stock, Doug. You know, ended today a bit lower, but it has been hitting these record highs. It's up about 35% now this year, Doug. In your opinion, what explains that run?
It's great to see you too, Josh. I think the run is really about two things. First of all, I think the Mag 7 in general, we've had a pretty good period, really since the election. We got past sort of the uncertainty about direction, right, at the top level for the country. And I think that you've seen sort of a return to some of these Mag 7 names. We've had some pretty solid performance. Nvidia's maybe been a little bit more choppy, but look at Google yesterday with their announcement on quantum chips. I think investors are sort of embracing mega caps as a category. The second piece is specific to Apple. If you look at their business, I think that the iPhone numbers, and investors seem to realize this, the iPhone numbers for next year are kind of de-risked. I mean, expectations are low. The street's at about 3% iPhone growth for next year. That feels very reasonable. And there's really no expectation for AI adding much of anything to Apple over the next year. And so you put those two things together, I think that explains a lot of why the stock has been working well.
Let's get your take too, Doug, on some Apple headlines today. I'm just interested to get your thoughts. One was we did see this report, Doug, that Apple now working on developing a server chip for AI. What did you make of that headline?
Not shocking at all. And I'll tell you this, I mean, we've been saying this, I think, for a year now. For any company that is playing in the AI space that has over $1 billion market cap, we think they have to develop their own silicon. It's just a matter of time for any of those companies who aren't doing it. Apple was obviously always involved in making their own silicon for their devices. Now they're bringing that into the server and doing it for their particular use case in AI. I think it's a smart move by them, somewhat predictable, but it also shows, I think, that they are serious about AI. And as they continue to roll out these AI features into new devices, they're going to have to use unique hardware, both on the device and in the server, in the infrastructure piece, to deliver those experiences that are so magical that their customers expect.
And Doug, broadly, what are the advantages for a tech powerhouse like an Apple to bring that chip design in-house?
It's really about efficiency, and ultimately that means lower cost of operation. And so what you can do when you develop your own silicon, you can take Google as an example with TPUs. They've really been doing this longer than anybody in the AI space. But what they can do, because they have a deep understanding of the hardware, and the hardware is sort of purpose-built to interact well and handle well the algorithms that they're developing, you can get some efficiencies out of that interplay between the hardware and the software that ultimately mean you can develop and deliver better experiences and have lower costs to deliver those experiences.
We also heard, Doug, today, Apple's going to start integrating Chat GPT into its devices. In your opinion, I mean, obviously investors are listening to this very closely right now. I mean, they want to know what that's going to mean for, you know, the upgrade cycle. How do you think about that, Doug? Both near term and perhaps longer term.
Yeah, Josh, we've been playing with it in the office here kind of all day just to test it. And the near term and the long term, I'll break them out as you suggest. Near term, I don't think it changes much to the story at all. You know, I think the expectations were low, probably from investors. but also from potential iPhone buyers. I don't think they're looking for AI or ChatGPT necessarily as the real catalyst to upgrade their phones right now. And incorporating ChatGPT, as Apple has done here, it's really a nice feature that they've added, but it's not breakthrough. Longer term, I think that's when you get into a world where it could be breakthrough. You kind of get a glimpse into what the future might look like, where you can actually talk and have a conversation with Siri, with ChatGPT as kind of the backbone behind that conversation. I think that's the world where we're going to, but right now it's really just a feature that lets you interact with ChatGPT through a voice interface.
More broadly, Doug, another question for you. When we talk about LLMs, large language models, and I'm interested to get your take on just the competitive dynamics, the competitive marketplace we find ourselves in right now, Doug. I mean, you all are there at Deepwater, you're invested in Elon Musk's XAI. How are you thinking about the competition in the market? Is it all OpenAI right now? Is it all Sam Altman and everybody else is kind of battling for the silver medal?
Sam Altman is a formidable competitor. He's very hard to compete against, but I actually think the landscape has sort of changed over the last 6 months. And you see a little bit of it today with Google and Gemini 2.0. I think that was a really strong release from some of the information that they put out so far. I've seen some clips where people are actually using Gemini 2 to play video games and sort of get advice real time. I mean, it's really cool what Google has built into their new leading LLM. And so I think if you look at the landscape today, it's very competitive. OpenAI, to me, is still in the lead, but you've got Google very close behind. I think Anthropic with Claude has done a great job. And of course, as you mentioned, XAI, obviously we are biased. We're investors at Deepwater. But I think that they've come a very long way in a very short period of time to build Grok into, I think, one of the top 4 or so models in the world.
And finally, Doug, we talked a lot about Apple. I do want to get your take on Google too, which certainly, made some news this week, claimed this quantum computing breakthrough, Doug, and the stock, we saw a pop there. I'm curious your take on that. What does it mean for investors looking ahead?
I think investors are always curious, and particularly in this market, for things that appear to have great option value for these big companies. And so when Google puts out what they put out the other day relative to quantum, I think investors say, hey, if something really hits here, you look at over a 5 or 10 year picture, quantum could be this meaningful potential upside case for Google. But if you kind of bring it back to the nearer term, bring it back to reality, I think what they did with Willow was incredible. It's a great achievement in the lab. But as we know, bringing something from the lab that's really impressive into production in the real world is really challenging. And my guess is we really won't see much from quantum, from Google, probably over the next decade if you really need to put kind of a time scale on it. So it's really amazing that they're doing this. As an investor at Deepwater, we hope they keep experimenting with this, but it's not something that I would expect to have a big impact on numbers in the near term.
Doug, always good to see you and have you on the show. Thanks for making time for us.
Thanks, Josh.
Stick around. We're asking for a trend right on the other side. The Nasdaq closing above 20,000 for first time as investors digest fresh inflation data. And Yahoo Finance's Josh Schaefer joins us now with the trading day takeaways. Joshua.
Josh, yeah, so we got to start with the Nasdaq, right? And really what was a mega cap led, I should probably say Magnificent 7 tech stock led rally in the Nasdaq. So I'm going to flip over just so we can take a look at it, because this is the first time we've seen the Nasdaq composite finish over 20,000, right? So let's just take a look at the round number, Josh, if we can. We don't quite have it there. I'm going to flip back to the Nasdaq 100 and take a look at tech stocks here. So really what we saw was a broad-based rally in a lot of these big names. Apple was actually at an intraday record high, didn't get a record close, but you got a record close for Alphabet, record close for Meta, record close for Amazon, and a record close for Tesla. Tesla's been an interesting one, of course, rallying since the election. If you zoom out to something like a 2-month or a 1-month, pretty big number there for Tesla. What's interesting as we continue to sort of come back to this Mag 7 conversation, right, is to remember these stocks are sort of rallying on different things. They're big. They help bring the market up. But think about Tesla. That's really an Elon Musk story, his relationship with President-elect Donald Trump, right? Alphabet had its best 2-day performance, according to our Jared Blickery, since I think it was about 2015. This 2-day rally that we've seen, that's of course their quantum computing chip really sparking that rally. And so when you look at the different parts of this trade, always think it's important to remember, not all necessarily the same thing. But one thing that I thought was interesting, I was speaking to Charles Schwab Senior Investment Strategist Kevin Gordon. He pointed out to me, think about this trade in the context of maybe higher for longer when we talk about the Fed, right? These are stocks that have done well over the last 18 months as rates have been high, as inflation has been a little bit sticky. Maybe that's part of the trade here. Maybe it's a little bit defensive. I know you had a guest on earlier that was also talking about that, right? Maybe Mag 7 can be a little bit of defense as we sort of wonder about what happens in 2025.
I also wonder how much too, what role, and we talked about it with some strategists on the show today, what role, just money managers chasing winners into year end is also playing with at least some of the moves we're seeing here too.
I mean, just look at the year to date on Nvidia, right?
Yeah.
It's a tough conversation to go into your conversation with clients at the end of the year. They're looking at Nvidia up 180%, and you say it's not on our book.
Right.
We didn't like the name, we weren't involved. You want it on your book, right? So I definitely think that's always something you start to think about when it comes to December. Josh, our takeaway 2 here that I want to get to has to do with what I was talking about, was sort of that inflation story, right? So we've got CPI out this morning. Largely the take seems to be, okay, CPI came in with expectations. We knew the expectations weren't great. Core CPI year over year moving up or staying flat. Overall headline CPI year over year moving up, but it was expected. So Fed probably cuts next week is the market's read. But the question is, your target's down here.
Yeah.
None of these lines, so we're looking at a 3-month annualized, a year over year annualized, and a 6-month annualized. So short-term trend and long-term trend, all of them are moving flatter up. That's not a great outlook, right? Quite simply going into 2025. So what does that mean for the Fed? Economists argue right now probably means less rate cuts in 2024 than maybe we thought a month or two ago. Be interesting to hear what Fed Chair Powell has to say about it next Wednesday.
Yeah, because I think to your point, you saw the CPI print and it was in line, but then the conversation quickly did turn to, have we sort of stalled out on our way to Jay Powell's 2% target? And folks were pointing out, your core CPI between 3.2, 3.3 year over year for the last 6 months.
Right, and then the question is that, with that, of course, Josh, is what does that mean from a investment standpoint, right? What sort of moves do you make? And one trade that I think is going to be interesting to watch over the next month, if I can find it here, where's IWM for me? There we go, small caps, right? Ben fits and starts with small caps now, really over the last month. So yes, it's been a Trump trade. It has rallied, but it's rallied. It's fallen back down. Even if you look at a 2-month, it should be in the green, but it's been volatile still. And I think when you look at a trade like small caps with about 40% of that index exposed to short-term loans, they're going to be coming back to market looking at higher interest rates. That's a concern for that area of the market. So that's going to continue to be this conversation into 2025. Okay, if we are higher for longer, what does that mean for some of these trades that have been hot, and will they not quite stay going into 25?
We shall see. Joshua, thank you. Stick around, much more Asking for a Trend right on the other side. A Goldman Sachs report found that AI-focused tech giants will spend over $1 trillion in the coming years, with a significant portion of capital targeting at data centers, AI infrastructure, and the power grid. The increasing power demand is expected to create a surge in demand for copper and other metals and minerals. The problem, there's already a global copper shortage. Joining us now is Vandita Pant, BHP CFO, and Yahoo Finance's Julie Hyman. Vandita, great to see you on set.
Thank you. Thank you for having me, Josh and Julie.
I actually had a broader question just to start, Vandita. I'm very curious, given what you all do, you're producing iron ore and copper, you have a unique line of sight into just the global economy, the health of the global economy. From your vantage point, Vandita, what are you seeing there?
Yeah, it's a great privilege to have the vantage point that we have, as you said, Josh, because we look at all value chains, the recognition of critical minerals and intensity of that to our economic growth is increasing. And what that means is it gives us a view of where the demand is coming, not just the traditional, conventional demand points, as you were mentioning, Josh, but also being amplified through energy transition, through AI and data center demand. And that is creating a trajectory of demand for minerals and metals like copper by 70% over the next 30 years, 10 million ton deficit over next 10 years. And that is a great opportunity for a company like BHP. As you said, a very diversified, largest miner in the world, lowest cost producing with huge organic growth embedded in our portfolio, but a great vantage point. So on your point on what do I see in the economy per se, I think very bullish on the investment thesis here in the US, given the focus on growth, on manufacturing, on energy security. If I were to zoom out a little bit, other regions, China continues to be a little bit what I would call an uneven growth story. In some sectors like manufacturing, infrastructure, exports, strong and solid numbers. Housing is where the drag is and continues to be. And you may have seen earlier in this week, Politburo announced some contours of the policy there, which is probably most pro-growth policy I have seen in last couple of decades.
So you are convinced by that, because there was some debate, and there has been some debate as there have been different stimulus announcements out of China about how serious they were or how effective those measures were going to be.
And because I think some have been effective and some not so, this pivot towards very growth-oriented monetary policy, plus fiscal policy, plus what is being called extraordinary counter-cyclical measures is all very pro-growth. Of course, we don't have the details of the policy yet, which usually happens in the Working Council, which will get unveiled next week or later this week. But if I were to say the government's targeting 5% growth, and that seems within reach from my perspective.
And Vandita, what about, I'm also curious about what you see in India, what demand looks like, what the composition of that demand is like.
Yeah, India is a very important market for us. As you would know, we are the world's largest in terms of high quality metallurgical coal. This is the coal which goes in steel production. So we watch that market very carefully. India has been a secular growth story and continues to be. Last quarter was a bit weak, but overall 6-7% growth trajectory is what we see in India. You have to remember that's the country where urbanization is just 30-35%. The country is yet getting built, which means the steel production in India is going to be really high. 4 years back, India was around 100 million tons of steel production. Last year was 125. We are into 150 million tons this year. By the end of the decade, India's aspiration is to go to 300 million tons. And that trajectory is very positive for the highest quality coal, metallurgical coal that we produce, which is what is needed to support that trajectory.
I want to ask about copper and the copper shortage that we referred to in the beginning. I would be remiss if I didn't ask you about your plans to add capacity, and specifically to add capacity through potential acquisitions. I know that you all had offered to buy Anglo American. It did not work out. it sounds like maybe you're leaving the door open to a second offer. Is that something? Talk to us about how you're thinking about all of this.
So let me unpack that a bit,
Yes.
quite a bit
Yes.
there. So firstly, in terms of Anglo, of course, we went for that because we saw there was a real unlock of value for our shareholders and Anglo's shareholders in the deal. As you know, they have chosen a different path, and that's fine. From my perspective, for a company like of our scale, of company which has the largest copper resources in the world, second largest producer of copper in the world, the biggest lever of our growth will be organic growth. Because we have such optionality in our growth, be it in our Chilean assets, where we operate the world's largest copper mine, where we have unveiled many attractive capital projects, or be it in South Australia, which is another place that we have assets which are growing within aspiration to almost double the production by mid of next decade. So organic growth across many time horizon is what my focus is, which is very attractive. So will be really value adding for the shareholders. But in terms of M&A, that is, there is no M&A which is a must-do deal for BHP. It's part of the toolkit, but not something which we need to focus on as a primary driver at all.
Vandita, great to have you on the show today. Thanks for making time for us.
Thank you, Josh.
And that is a wrap on today's Ask for a Trend. Have a great night.